Good morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, 7:30 Mountain Time. Our note this week in the wake of the red wave was the threat to bureaucracy. So we apologize if anyone doesn't see the humor in calling what people on the left were describing as a threat to democracy, the threat to bureaucracy. We used it as a lead into our discussion of the outlook for the regulatory regime and financial sector in particular. And we did indeed add to our exposure in financials in the wake of the red wave. So we began the note by discussing the role that the collapse in volatility played in the rally last week. The fixed income move index dropped from 130 down to 100. That contributed to a tightening of spreads in mortgage-backed securities. But interestingly, swap spreads, which we've been using as an indicator of how the market was struggling with supply, actually rebounded in the 10 and 30-year part of the curve. We had a very successful 30-year auction following the election, which we found a little bit surprising. We thought there was a chance that 10s would trade to 450, and while they threatened to on election night, the market, fixed income markets seem to react pretty well, and market seems okay with the risk to supply right now. That's been our position, is that ultimately a Harris administration would have been worse for the long-term fiscal outlook because there's virtually no chance that spending would have been reduced from its elevated 24% of GDP level back to 20%, that effectively average over the last 50 years. And that it may well happen under the Trump administration as they get into the budget reconciliation process and look to make the Tax Cuts and Jobs Act permanent. The only way to do that will be to come up with spending cuts. Additional revenues from tariffs, for example, are not going to get them there. So one important additional comment right off the bat is that the Trump administration is not inheriting a great economy, as some on the left have postulated. Earnings growth, ex-tech and communication services, is only going to be up about 3% this quarter. The industrial sector earnings are down nearly 9%. The industrial sector itself manufacturing remains in a recession. Housing's in a recession. The small business sector's in a recession. And we use the Atlanta Fed wage tracker to illustrate just how much and why we got the election result we got in essence, because that bottom quartile of wage earners was making some ground up against higher income quartiles before the election, after the passage of the Tax Cuts and Jobs Act, I should say before the pandemic. They got a big spike in relative wage growth in 21 and 22, but not enough to offset the big spike in consumer prices. And now their relative wage growth is the worst it's looked in quite some time. And so they really have struggled with the way the Fed went around the tightening process, and the fiscal policy impulse that we've gotten really has left the bottom income quartile. Immigration's obviously played a big role here as well. So that's it on that. We moved on then to discuss the Basel risk-based capital framework, which we think was a bad idea, born in Europe. It's turned our largest banks into effectively government bond funds. It makes them play a much larger role in financing government borrowing rather than the private sector. And we hope the Trump administration will usher in the end of the Basel endgame. Again, to really get all the details, please consider becoming a full subscriber, or at a minimum asking us for a trial. We just gave one out a few minutes ago, so we're always happy to do that. Moving on to tariffs, we want you to remember that tariffs are changes in relative prices. Effectively, they are something of a tax on imported goods. China, Germany, all the big countries running huge trade surpluses and are not in a position to retaliate against us. We're the trade deficit country. They are the trade surplus countries. They need us unless they're willing to restructure their economic models, and so far they're not. So it's not inflationary. Inflation is always and everywhere a fiscal and monetary policy phenomenon. Our real inflation risk remains that 24% government spending as a percent of GDP. We don't have a tax or a receipt problem. We illustrate that in the note. We show how tax receipts are within 4 basis points of their average since 1947. We don't have low receipts. We have too high a government spending. So moving on to the Fed, we do think the Fed is going to cut another 25 in December and in January, and then there's a very good chance they could go on hold for the rest of the first half of 2024. Again, details in the notes. We're still worried about their balance sheet, and we do think they're going to be faced with a decision about ending QT early in the first quarter. Inflation data this week, goods prices are still under global pressure. Chinese PPI over the weekend showed you they're still exerting a deflationary impulse into the rest of the world. Super core service inflation could become something of an issue. That's something to watch this week. And as I intimated right at the beginning, we made some changes to our sector and asset allocation. We're extending duration in our fixed income portfolio, which remains still below benchmark. We're at 70-30 rather than the benchmark 60-40. That's stock to bonds. We're cutting our healthcare exposure and adding to our financial sector exposure following the red wave. That's it for me this week. Barry Knapp from Ironsides. Again, consider becoming a full subscriber. Have a good week, everyone. Thank you.